Hey everyone, Alan Brochstein from 420 Investor and New Cannabis Ventures. I hope you had a good week. It was another rough one for the market. We are now down 18.4% year to date for the global cannabis index. I also like to look at the ETFs, and most of the ETFs are down 20% or more. Been a rough start to the year. I'll get back to that in just a minute. The goal of this video is to give a preview of the upcoming New Cannabis Ventures weekly newsletter that we publish on Sunday mornings, and that newsletter consists of links to some of the most important news of the week, as well as an overview of some of our current thinking. And so this week on the curated press releases, which those tend to be around financial reporting, capital raises, and M&A, we had 4 stories this week. One of them was on financial performance, and that was High Tide. And in this day and age, to see a company actually meet its expectations is really nice. High Tide, it's under the radar, I would say, for a lot of people. It started off as being primarily a retailer of cannabis in Canada, and it's really broadened. It was always an ancillary company as well, but it's doing that. It had a wholesale business up in Canada, and now it's gotten deeper into the United States, both e-commerce, direct to consumer, and then it also is a CBD business globally. So their quarter 4 ended in October, and revenue, which included a lot of acquisitions, so it's not organic, grew 117% to about 54 million Canadian, and their adjusted EBITDA was slightly positive. I think that was like the 5th or 6th straight quarter. So that's in the index. It qualifies. It trades on the NASDAQ if you don't know that company. So the other 3 curated press releases were capital raises, and they're all very interesting. The first one was Agrify, and Agrify really shocked the market, if you ask me. Any financial analyst looking at their numbers has to be scratching their head. It's very difficult to understand why they raised capital, and it's really a red flag to sell stock near an all-time low. This is a company that went public at $10, and it really kind of crapped on its shareholders. If you ask me, when it did a secondary offering like a month later, right? The stock shot up, and they said, "Oh, great, we're just going to grab more money." And so I don't want to beat on them too badly, but I've been really negative on this one with my subscribers at 420 Investor, and for a lot of reasons. I'm not going to get into that right now. But this offering, not only was it surprising to see, and remember, they had a short report that came out recently, so it was a surprise to see them raise money at all, but the deal came with warrants. And if you're not familiar with how that works, warrants are not free money, right? If you're a company and you issue warrants, I've heard some executives in our industry stupidly say, "Well, it's great, you get more money at a higher price later." No, those are valuable call options, and it allows people to short your stock and pick up those call options to hedge themselves. So this was not a good deal. So it's interesting, we're in a period of weakness, and a lot of times companies will grab money, try to grab money. This was a very poor attempt to do so. Another one was Jushi. Now this should not be so concerning, in my opinion. They raised $10 million selling straight equity, no warrants attached. And I think they were pretty straightforward in why they did it. They just said they're looking at a lot of M&A, and the money that they're raising, they think they can put to work. Now, you can be a Jushi fan or not a Jushi fan, but I think that's pretty straightforward thinking. And they have a debt facility through Sundial, actually, or an affiliate of Sundial, and they can use that, but sometimes it's good to have your own cash as well. So I know people might have been disappointed to see that capital raise at a relatively low price, but unlike the Agrify one, it was a much smaller amount compared to the market cap. Market cap of Jushi is close to $1 billion, right? And it was 10 million, so less than 1%. I mean, about 1%, sorry. And And then the Agrify one was like more like 5% or something like that, and it had warrants. So a little bit of a difference in those two scenarios. And then also the Jushi one went to one institutional investor, which I think sometimes gives investors comfort to know there's an institution stepping in and buying it, and not an institution that's buying your offering to short the stock and keep the warrants. So, and then the final one, which continues to be a major theme in the market, that the better companies are able to access capital at better rates than they have historically. And so in October, Trulieve had raised, I want to say 400 million. I don't remember the exact amount, at 8% for 5 years, 2026? Yeah. And they reopened that issuance, and they issued an additional 75 million on the exact same terms as they did in October, 3 months later. So, just another reinforcement of this idea that the good companies have access to capital. And that I'll come back to in just a moment. So we run exclusive content. I talk about this every week, and this was a light week. Usually we have 2 interviews. We just had one. We had no other exclusive content. Next week, I promise, will be busier on that front because we'll be reviewing all the indices. We'll have some BDSA data. I'm going to do a revenue tracker tomorrow, a revenue tracker update. Trying to think what else we might have. We'll have an Illinois piece probably. So super busy on the proprietary content next week. But this week it was just one, and we interviewed Curaleaf, the CEO Joe Barron, and not a lot new there. He did kind of confirm that they met their guidance for Q4, which I don't know if that was news or not. I hadn't seen that officially anywhere. So nice to hear that. And like I said, on High Tide, in this day and age, just hitting the numbers feels like a good thing when your stock price has been chopped. And so on the interview, he talked about the 4 pillars of Curaleaf. And I'll be honest, these companies all start to sound the same. We're trying to have great products and invest in our people and have a great platform. So, we try to find the points of differentiation. And really for Curaleaf, I think the point of differentiation is in Europe, right? And so we did talk about that in the interview as well. You can read Carrie's write-up, and we also have included a link to the entire interview. So that gets me to the conclusion of this discussion, which is about, as I said, each week we share some proprietary content in this newsletter that is intended to help our audience become aware of issues they may not be aware of or stimulate thinking. And so this week, wanted to reflect upon this meltdown that we've had in the market, and it changes things, right? And I think one would be foolish to expect the cannabis sector to hold in when everything's melting down. I talked to my subscribers at 420 Investor about kind of the casino, and right now the casino is emptying. People were taking a lot of risk. They're buying Bitcoin, Tesla, psychedelics, whatever it is, last year and in 2020 as well. And, with the fear of the Fed, and, I'm an economist by training. I have some views about what's going on. It's not really the point. But the reality right now is the overall market is off to a horrible start, the worst since 2008. And we know that was not a normal correction. That was a protracted downturn. And so what does that mean for the cannabis sector if this weakness that we're seeing, not only in the cannabis space right now, but in the broad market persists? And so it's really kind of simple, but I think it's always worth reviewing. And in the 9 years that I've been following the space, I've always tried to preach to anybody that will listen to me, pay attention to the balance sheet. And it's not just the balance sheet, it's also cash flow as well. And that's really the answer right now. There are some companies that can weather the storm and others not so much. And to me, honestly, it's been very painful because there's some companies I really like. And in my model portfolios at 420 Investor, I've had to reduce or eliminate some names because I'm concerned that they might not be able to weather the storm, or the investors will, maybe a better way of saying it is, investors will perceive that they can't weather the storm. And so it becomes a game of getting out of the names. They're already down a lot, so you're not going to look like a genius selling them. But if they're going to go down a lot more, it's the right thing to do. And it's a really tough thing for investors. And I'm not going to tell you what to do. I can barely tell myself what to do, but it's a very tough game. But the point of this was there are some companies out there that can weather the storm better. And we mentioned a few by name. I mean, I find it kind of interesting. I think I did an interview this week with Rena Scherble over at Seeking Alpha. And, you know, I said at the time, and this is still the case, I don't have a position in GTI because I think some other stocks look better, but I think it's the best company, or at least at this moment, it seems like it's the best company. And, you know, you look at what's going on so far in 2022, and it's down, I believe, 23%, which is more than the market, which is more than several of its peers. And so sometimes you get an opportunity maybe, and I'm not saying, like, I haven't done it yet, but that's the way I'm starting to think, and I think that's the rational way. I mean, look, a lot of people in a situation like this will just say, I'm out, I'm selling out. And I got to tell you, that may be the right thing to do. I remember in November, late October, feeling like that was the right thing to do. I was either stupid enough or smart enough not to do so. And we had that huge rally, and GTI itself rose 50% in like a week or two. So that's the risk you run if you just head for the hills. So kind of an alternative to heading for the hills and just biting the bullet and selling, which could be the smartest thing to do. The alternative is to just upgrade one's portfolio and move into names that are likely to weather the storm better. We shared a few of them, but it wasn't really so much about giving people a list of names that they can blindly invest in. It was more an example of, you know, there are certain names out there and they actually have fallen by more than other names. And so it's a real potential opportunity if the market's going to continue to be pressured, and I'm talking about the overall stock market, to upgrade one's portfolio. So I'll leave it at that. I always end these videos by wishing everybody a good week, and recently I've had to say I hope this week gets better. Hey, I don't know that last week was better than the week before, but in the week before we dropped like 11% and we were down only 5% or so this week or whatever it was. So it's been really tough. I told my subscribers at 420 Investor, 9 years into this, and there have been some painful downturns, and of course the vaping crisis followed by the pandemic was pretty brutal. And in that year, from the high in March of 19 to the low in March of 20, the market dropped like 80-something%. So far, we've dropped close to 70% from the peak. And the thing that's different this time from that time, in my opinion, is that the fundamentals and all, what's going on is not nearly as daunting for the cannabis industry as it was 2 years ago, right? From that peak in March of 19, not really that part of it, but in the back half of that, when the stocks really started to sell off hard, that was a time when access to capital didn't exist for most companies. So, and also most companies weren't cash flow positive. So I'm going off on a tangent here, but I guess what I'm trying to say is, I think the market's overdone. I really do, but that doesn't mean that it's not going to keep going down. But I'm going to hope that's the case. Take care, everybody. Have a great weekend. Stay warm.